Dollar cost averaging is an unemotional investment strategy where you invest a fixed dollar amount at regular intervals, regardless of the price when you buy. It is not always easy to invest in stocks when the market is declining. Concerns may develop, like, what if the market continues to decline after I invest? In general, the market moves in cycles, typically in large chunks, and in what we consider to be short time periods. However, no one can predict the future, and while no two markets are the same, and past performance is never an indication of future results, historically, what we have experienced might suggest that dollar cost averaging may be a worthy strategy to consider, particularly in a bear market. Let's assume that you have $1,200 that you want to invest in a particular investment priced at $10 a share. You could invest all of it at one time, have 120 shares, and hope that the price climbs higher. But what if the price goes down? To mitigate this risk, you can dollar cost average $100 at the beginning of every month. In this hypothetical example, the benefit of dollar cost averaging in a bear market is that your average price per share will be less than if you had jumped into the market all at once. Then, if the market climbs higher, you have more shares, regardless of the market climb, and a lower break-even point than if you had invested everything at $10. It's important to understand that dollar cost averaging will not protect you from loss and does not guarantee a profit. However, dollar cost averaging has the potential to make what we feel is a significant difference when investing in a bear market. Please subscribe to our channel for more Dunham insights.